right, glad to have you back. Yes, I introduced him earlier. Mr. Onigbinde is the co-founder, CEO, Budget. Thank you so much. It's good to see you.
It's a pleasure being here, Tolu. My apologies. Yeah.
Yes, no problem. We have you now, and let's get on talking. Now, I'm sure you're aware, late yesterday when Mr. Ajuri released that press release was released saying President Tinubu signs executive orders for oil and gas reforms, and this is aimed at opening up that sector, attracting more investment into the oil and gas space. I want you to tell us what this means for you before we go into some bold steps that many have said has been taken by President Bola Ahmed Tinubu.
Yeah, I mean, it was interesting that like a multi-stakeholder framework came together and they decided that we needed to improve the incentive structure in the oil and gas regime. Let's not forget that after the Petroleum Industry Act, which also is not like a definitive act, things still needed to be improved and changed. And I think this executive order, which certain people will still have to figure out if it is legal enough for the president to do these things, but he had put forward some years on how to change the oil and gas. And most of it is about giving incentives to companies that want to invest, especially in gas. We would argue that non-associated gas environment has not seen significant investment in the recent times. And a whole lot of challenges in there. One is pricing, because also there's a certain level of commitment that has to be made for the local power generation industry. And secondly, it's also pricing. Like, the pricing is not competitive. It's created this backlog of payments for even the generating entities. So to give tax credit to greenfield investments, that sounded interesting because it looks like those who want to do 0 to 100 million standard cubic feet of gas, there's a tax incentive for them. And also, it's also tried to give support to those who even have existing one, or maybe they have a 25% gas investment allowance to apply it to them. It's just an incentive structure for those who are either doing greenfield, which are new, or brownfield investment, and just incentivize them to accelerate their investment in gas sector.
So you just mentioned the almighty PIA, and that's what came to my mind. Well, as a journalist, I would ask you that I hope this would not affect, because already PIA is being implemented. So what does this, I hope there won't be any conflict of interest in all of this, or this is just for a stipulated time.
Yeah, I mean, some of the things that were said here, let's be honest, the PIA did not cover them.
Okay.
The fiscal for the PIA was not as detailed as it should be. And I think some of this was, I think it was a bit tilted to the oil component of things. The gas side of things, there still needed to be some clarification in how some of the fiscal structure can be set. And let's also not forget, incentive structures are now different within the sector. The C sector, the incentive structure has to be a bit dynamic, because the oil and gas industry you were dealing with 10 years ago was not what it was 5 years ago. We're in a time where there's an acceleration of gas production, especially at the Middle East Asian corridor. So it's something that it's a problem. It's a huge problem in a way. So for me, Nigeria also wants to accelerate and wants to become competitive and look a bit exciting for the oil and gas industry, which is necessary. And at this, so I feel there will be oil and gas legal experts that will look if an executive order, because an executive order cannot supersede the legislation. If the president has not breached the legislation in here, and I think if the president has done that, then we might have to look at it for the modification or the amendment of the PI.
At a time where many are talking about energy transition, and we're still doing a lot around fossil fuel, what do you think, or how prepared would you say is a country like Nigeria to transit when it has to do with energy?
It's still a big problem because transition to energy is a lot of work. And I don't think we ourselves are paying extreme attention to what it should be. Let's be honest with ourselves. We have spent significantly on oil. Whereas not just oil, I mean, they are apart from I think cobalt that is facing some reduction in prices, most of the transition metals like copper, have been priced at a high level at this point. And we have some of these things also within the country. We have not invested in the solid minerals as we should be, and that is facing a significant challenge. So there will be energy transition, definitely, but to be honest, we are not going to watch our oil and gas assets just get stranded or get to waste. So as we are also trying to find a balance with energy transition, we will still have to, in the same way, figure out the way to get the maximum, returns or the maximum income from our oil and gas region. We have not done that well recently. We know that even when oil prices were sky high at $90, $100, we were not producing. Even till now, we have not been able to even hit 70% of the quota that was given to Nigeria. So there's a big problem in there. We also even have to first maximize production. When we maximize production, then we now get to the next phase. And that next phase is that we need to also be able to attract investment. I think what the president is doing now is he has understand the basics. If you want to face the fiscals, which has also impact on the monetary base, we have to be a productive country, especially for the oil and gas that can give us scale at quick ones. And at least you want to attract investment. You want the development and FID, all of that to happen. In another 2-3 years, you now have significant earnings, improve the earnings from oil and gas. And even if you don't get it in the next 2-3 years, another 5, 6, 7 years, by when those tax credits expire, you'll be able to now get the full value of what the government should get. So it's all about geopolitics at play here. Nigeria also wants to attract investors in its oil and gas, but all of that will not change. The gas pricing system and the domestic gas obligation, all of that, there's need to be a tinkering around that environment until domestic gas obligation and the pricing around that, until there's a big conversation around that. You might not be able to see accelerated investment. And also security. There has to be a big play on the security around this investment. If we still run around, because there are too many places to put in money now. There are new fields everywhere in Guyana, even in Africa, even in South America, even Middle East, where the cost of production is insanely low. We have to understand that we also have to keep being attractive for investment. And there is no way around that except we fix security and we have conversation on domestic gas obligation and also on the pricing that's around that.
Indeed, issues around gas is the focus at the moment, even where we're talking about CNG, LPG, and all of that. But before we move out of the oil and gas space and talk about some other policy issues, there is still divestment in the oil and gas space. We still see a company like Shell leaving. So what can we do, or what can be done to halt this kind of move by these multinationals?
It's not a recent decision. When you look at this issue with Shell leaving, it's not something that it's new or something that is recent. This is something that has been bubbling up over the years. And it's a problem that the onshore production is become very risky, unattractive, and maybe unprofitable for most of the oil and gas. And it should be, to reach production at an onshore level is not as difficult or it's not as expensive compared to a deep offshore production where you might need years to set up platforms and to be able to get to where you want to be. But onshore, which is our quickest, route to be able to ramp up production, is also facing significant security attacks and pipeline damages and all of that. And a lot of these IOCs, uncertainty is a big problem for them. They want to set projections, they want to hit projections. If uncertainty pervades because of the level of insecurity, you will have to make a big decision. And that big decision is simple. We will have to find a way to sell maybe to a local consortium or to another entity that is interested. And that is what is happening. So until Nigeria faces the insecurity issue around its onshore production, it's going to be likely unattractive for most IOCs who need a bit of certainty around production. We'll still say that we haven't seen new investment that might come in play on the deep basin or the offshore or production, and I think that is really helpful. But especially for the onshore production, I think it's a trend that has come to stay. That we might have a shifting mix where it will be more of local players, or maybe mid-sized players that are able to attract that interest. And I think it's not a bad idea. Even though you want to put up a 100,000, 150,000 onshore platform, it's good. But if what you get is a 25,000 here, 30,000 here, 50,000 here, a 10,000 here, and to be able to power modular refineries, to be able to meet some of obligations, maybe, for example, to Alhaji Dangote, all of that gets to happen at the end of the day. So it's a trend that has come to stay. And I think what we have to find, how do we deepen the capital, deepen the capital budget, and also the local bank, how do the local financial institutions have a play in all of this? Because nobody's going to take on a risk as that nature, so we're going to raise finance to be able to make its production.
Wow. Let's look at the downstream before we talk about other economic policy issues. Now, the downstream is also, how would I put it, there are a lot of issues surrounding the downstream, and we see the likes of Dangote getting on board for refining and all of that. So my question really would be, how do we also address the challenge with regards downstream, availability of products, pricing, and if at the end of the day, both refineries, Port Harcourt and Dangote, become functional, what positives do you think that holds for Nigeria in any form?
The downstream, it has a whole lot of challenges.
Yes.
And the challenge with the downstream is that it's not fully deregulated. We know this. And with the exchange rate moving in 1,500 northwards, which means that the current price that we pay for fuel is currently being subsidized. The IMF made mention of that recently.
Yes.
There's a big problem in there. And it's just because maybe you put two rods in fire at the same time. You're trying to do subsidy removal, and at the same time you're trying to put a bit of liberalization on the FX market. I think maybe that's where our problem is stemming in. And so even at Dangote, except you pay in crude at a discount, I don't see where the advantage is coming in, because he would also want to price at the premium that it should be at the end of the day. So and for years, NNPC has been the ones in that gap, and also I think it's become efficient. So it seems we are falling into the bigger trap than what we even were used to, because I can bet that the current situation that we have right now, we might be paying more in subsidy than what we used to pay for before. So there has to be a big question in this, technically, from the side of the government. What needs to be done different? And it's simple. There's a need for an exchange rate stability. You have actually to know which price are you going to arrive at. And also, maybe the government will now make a decision to do like a crude sale discount, because I also have to look at the social impact of this. If fuel is being sold at 650 naira per liter, if at that point it doesn't, if I would say let's go full market, and that becomes around 1,500. Diesel today is around 1,650. Fuel is always like a 10% notch lower, so it tells you the full price of petrol today be around in the 1,400s. Now, do we want to put that burden on Nigeria? So it's something that has to do with the exchange rate appreciation is what we have to do. A stable exchange rate is useful for some reason. I think that's what the CBN and NNPC need to target aggressively at this point. And there's no other way to it. Production has to be raised so that the federal government can pick a little bit more from that sector. And if we would have to find a short-term cash, a short-term FX to inject, it could be an Eurobond, it could be something, so that we can rack up some level of stability. I will now figure out how to smoothen the curve over the years they require that. But we're in a time where we cannot increase the price of fuel again significantly unless we want to cause a bedlam. So I think the downstream sector will continuously be trouble until this, as long as the subsidy regime removed. And it looks like we have made a big mistake. We are not getting out easy.
A lot of work to be done there. Well, finally, before I let you go, Mr. Onigbinde, a lot of policy issues that are impacting Nigerians. We hear some say negative, we hear some say positive. But some say it's a gestation period. We need to wait for some time before we start to see all of this materialize. What are your thoughts, or what are you thinking is the outlook moving on in 2024 despite these challenges?
I think the current government may have taken some hasty decisions in my own view. I feel like it should have just had a bit of, but the consequences are here with us. The positive is that there's a big attention being paid to macroeconomic stability. So that's helpful, because that means that they want to rein in inflation. They understand that the current ways and means mechanism is unsustainable and has an inflationary impact. They understand that they need to find a way to constrict or restrict money supply in the economy. So there are a lot of, neoliberal, if you allow me, is that macroeconomic fundamentals being put at play. You also want to balance that as much as possible. And the balancing of that is that the fiscal tightening has to happen. It must be capex for things that are necessary, capex for things that are useful. That's what you want to put money upon. So the fiscal tightening is what I have not seen. I look at the 2024 budget, and I still see a long list of frivolous items that would not have impact in the immediate. That's something the current government has to see. Then you also now have to figure out a way to accelerate capital for small business, genuine, not politically motivated, genuine small businesses. Because at the current prime rate, which is inching around 30%, with the current move by the CBN, I don't know how businesses are going to survive the 30% or compete at the 30% credit lending rate. So that also has to be something the federal government needs to put on the table to be able to drive or deliver kind of impact that it wants. For me, in terms of the gestation period, a whole lot of things will depend on the sincerity of the government. If the government is sincere enough to also tighten its own belt, and the citizens sees that, then we might begin to see a shorter gestation period. If the pressure is being on the government, citizens might not see any move or any changes in the immediate time. The reality is that what we need is not uncertainty. We can deal with devaluation, we can deal with depreciation. We just need a bit of stability and certainty. Prior to 2015, there were depreciation, there were devaluation of the currency, but at least there was a window stability. So the CBN was actively involved to be sure that we keep the exchange rate within this window. It's something the CBN has to figure out, because the current issues of rapid devaluation of the currency is having multiple dimensional impact on the economy in terms of inflation, in terms of even crushing poverty and all of that. There has to be some big answers on the table.
I must thank you so much, Mr. Oluseun Onigbinde, the founder and co-founder Budget. Thank you. It's really good to see you. Thank you for joining the program.
It's a pleasure. Thanks so much. It's a pleasure.